Let me ask you a question. What would you do if you had $500 per month to invest? What would you invest it in? That's $16 a day. That's more than what most of us spend on coffee, on gas station food, subscription services like gym memberships, and maybe that one streaming service that we haven't opened since 2020. Guilty. But what if I told you that in 10 years, that $16 a day could turn into $100,000, and in 20 years, $382,000, and in 30 years, approximately $1 million, give or take, from $16 a day? I'm going to show you exactly how I would invest that $500 per month, the exact ETFs, the exact percentages, and why it actually works. No fluff, no gimmicks. So let's get into it. Hey, my name is Michael, and on this channel, we talk about investing and personal development in a way that's actually simple and understandable, because I'm really simple and sometimes understandable. Also, because I'm not trying to build the perfect portfolio, I'm looking at something that I can build over the next 20 to 30 years. And today's video is something I genuinely wish existed when I first started my investing journey. Because the advice online sounds something like this: just invest consistently. Okay. And what? How much? And why this over that? That's what we're answering today. Here's where most people get stuck. They either do nothing because they're overwhelmed at trying to figure out the perfect strategy, or they do too much. They switch between 15 different ETFs, hoping that they're actually going to make progress. It's literally like trying to get in shape on a workout program and you're switching every 3 days. You're busy and you're definitely sweating a lot, but what is the actual progress that's being made? Can you define it? What builds actual wealth isn't complexity. It's a simple system that you can repeat month after month, year after year. So here's the framework I would use, and I actually am doing. I call it the three bucket portfolio, or framework. I'm still working on the title of this, and realistically, I'm not sure how this is going to be editing, so this might look really bad. But realistically, it's just 3 buckets. That's it. Bucket 1 is for growth. It is 50% of the portfolio and it's $250 a month. Bucket number 2 is for broad market, and it consists of 30% of the portfolio and it is $150 a month. And bucket number 3 is for income, which is 20%, which should be $100 per month. I really hope my math is right on the 100% part of it. Every dollar has a job, so every month you're just showing up, putting money into it, or $16 a day, like we discussed. Let me break down what goes into each one of these buckets and actually why. Bucket number 1 is for growth, $250 per month. This is where you actually build wealth over time. It's kind of obvious. It's called growth. The 3 ETFs that I want to look at here are SPMO, QQQM, and VGT. SPMO, the Invesco S&P 500 Momentum ETF. This one tracks the top performing stocks in the S&P 500 based on price momentum, essentially what's working right now. Its 10-year annualized return is 19.34%. And get this, in 2024 alone, it returned 45.82%. And in 2025, it returned 26.58%. It rebalances regularly, so it's always rotating into strength. The trade-off, it had a portfolio turnover of 54% in March 2026, meaning it moves around a lot. Next is QQQM, the retail-friendly version of QQQ, tracking the NASDAQ 100. Over the past 5 years, QQQM returned 15.59% annualized. This is the ETF holding Apple, Microsoft, Nvidia, and Amazon. The company's reinvesting everything into growth instead of paying you dividends. Lastly is VGT, Vanguard's Information Technology ETF. The 10-year annualized return on VGT is 24.11% with dividends reinvested. That means $10,000 invested 10 years ago is now worth over $86,000. The catch is that 98% of VGT is allocated to technology. So when tech has a rough year, this one feels every bit of it. Here's the thing. You don't need all 3 of these. You can pick 1 or 2 based on how much concentration you actually want for growth. And I'll be honest with you. This bucket will make you feel like an absolute genius in a good year, and in a bad year, make you question every single thing and decision you've ever had. QQQM's maximum drawdown since inception was 35%. That's the price of admission for those types of returns. If you can't stomach to watch your portfolio drop by a third, then scale this bucket down. Bucket 2, broad market, $150 per month. This is your foundation, your anchor, the thing that keeps your portfolio from acting like a roller coaster whenever something changes in the market. The ETF here is VTI, the Vanguard Total Stock Market ETF. VTI's 10-year annualized return is 14.52% with dividends reinvested. A $10,000 investment 10 years ago would be worth $38,798 today. But here's what makes VTI special. You're not just getting the NASDAQ, you're not just getting the S&P 500. You're getting the entire US stock market, over 3,500 companies, large cap, mid cap, and small cap. Sectors like tech, healthcare, financial, consumer staples, everything. So when tech rotates out of favor, and it will someday, the broad market bucket actually keeps everything working. VTI returned 26.05% in 2023, 23.81% in 2024, and 17.10% in 2025. 3 consecutive strong years. And even in the brutal 2022 downturn, when growth ETFs got hammered, VTI pulled back less than the high concentration alternatives. Oh, and did I mention the expense ratio is literally only 0.03%? That's $3 a year on every $10,000 invested. Practically free. Bucket 3, income, $100 per month. This is the smallest piece, but don't underestimate the power of what this bucket actually does. The 2 ETFs that I look at here are SCHD and DGRO. SCHD is the Schwab US Dividend Equity ETF. SCHD has a 5-year dividend growth rate of 10.6% and a current yield of 3.80%. These are high-quality companies with strong balance sheets, selected specifically for their ability to keep growing their dividend over time. DGRO, iShares Core Dividend Growth ETF. DGRO has the highest 10-year annualized return of the major dividend ETFs at 13.01%, with a 5-year dividend growth rate of 9.2%. If total return matters more to you than current income, DGRO is the better pick. If you want the higher current yield and faster growing income, SCHD wins. Personally, at $100 a month, I would split it, $60 into SCHD and $40 into DGRO. But either one alone works perfectly fine. Now here's what this $100 a month is actually doing for you, because it's not about getting rich from a small dividend payout. Number one, it's lowering your volatility. SCHD's 1-year return was 24.60% compared to VTI's 31.25%. But in down markets, dividend quality ETFs fall significantly less. They cushion the blow when everything else is bleeding. Second, and I'll be completely honest here, there's something psychologically motivating about seeing actual money land in your account. Even $15 or $20 in dividends is a reminder that your money is working. That motivation keeps people from panic selling when the market drops and everything else feels like it's falling apart. Don't underestimate the behavioral side of investing. It actually matters more than you think. Now, the part that you've all been waiting for. Let's get into the math, because this is the part that should genuinely actually excite you. $500 a month is $6,000 a year. Since 1926, the S&P 500 has averaged about 10% annually. Using a blended 10% return for this 3-bucket portfolio, which is historically reasonable, here's what $500 a month becomes. 10 years, approximately $102,000 on $60,000 contributed. 20 years, approximately $382,000 on $120,000 contributed. 30 years, approximately $1,130,000 on $180,000 contributed. You put in $180,000 over 30 years. Compounding generated over $950,000 on top of that. That gap between what you contributed and what you ended up with, that's called compounding. And the only way to access that is time itself, which means that the second best time to start was yesterday, and the best time to start is today. The reason I like this 3-bucket setup isn't because it is the highest paying portfolio. It's because it's actually survivable. This framework is generally close to how I think about my own investing. And like I said, this is what I'm doing for myself. And it's not because I've backtested every combination. It's not because I have a background in finance, but because it's easy enough and simple enough for me to do consistently, even when the market's doing something that makes my stomach hurt. And consistency more than anything else is what actually rewards this. So there it is, $500 a month, 3 buckets, specific ETFs, and the numbers behind them. In a future video, I'm going to actually walk you through how this scales at $1,000 a month, what I'd add and adjust. If you want to follow along as I build in real time, subscribe. I try to post every week. Please click the like button if you like this video, and hit subscribe if you want future content, and I will catch you guys on the next one. Stay consistent out there.